Hi everyone, my name is Hanif, and today I'll be sharing with you why China needs to pursue economic reforms to protect itself from US financial sanctions. Now, for some context, the financial sanctions that the West has so rapidly and completely brought to bear on Russia, particularly the freezing of its central bank's dollar assets, have awakened the Chinese political leadership to the potential effects of similar sanctions on China's vast holdings of foreign assets. Now, given Xi Jinping's ambitions to reunify Taiwan with the mainland, we can expect that policymakers will expend significant energies in the coming years to insulate itself from this vulnerability. Successfully doing so, however, would necessitate fundamental adjustments to the structure of the Chinese economy and its growth model. In this presentation, we will outline potential strategies that China may take to ensure or reduce its vulnerability. All are going to be difficult, but some are going to be more likely than others. So, late in April 2022, Chinese regulators reportedly held an emergency internal meeting where they asked representatives from major foreign and domestic banks operating in China what it can do to protect its foreign reserves from US financial sanctions. The responses were mostly uncertain and so hinted at the difficulty of achieving this objective. So now, how did China get so exposed in the first place? To start with, China's $3.2 trillion in foreign reserves are the result of the external surpluses that it runs, as China must acquire foreign assets in exchange for the goods and services it supplies on net to the rest of the world. The root of its persistent FX reserve accumulation, therefore, is the weakness of its domestic demand relative to exports. Its current account share of GDP has consistently been positive for the past few decades due to the surpluses in its BOP position. Put differently, the inescapable logic of balance of payments imply that China must rebalance its economy if it wishes to reduce its vulnerability to financial sanctions on its dollar reserve holdings. Now, how can China rebalance? Currently, counter-cyclical policy is focused on supply-side expansion and not really demand-side measures. However, with investment rates already amongst the highest in the world and further investment likely facing diminishing returns, increasing household consumption may be the only viable option. Now, how can China increase consumption? In the short term, it needs to reverse the damage done to consumer psychology from the pandemic shock and correct the suboptimal policy response in the form of zero-COVID policies. In the long term, it needs to boost healthcare and social security systems. The existing gaps in social security in China are very well known, and such gaps act to raise precautionary savings, which reduce households' consumptive potential. However, both these strategies are unlikely to happen. Given the financial constraints of local governments, social security expansion will require reforms where local governments keep a greater share of the tax revenue pie. At a state council teleconference, Li Keqiang stressed that local governments should expend more stimulus, but will not receive any new fiscal transfers from Beijing. Also, the government maintains that zero COVID will be in place for the foreseeable future. Another strategy could be to appreciate the yuan, as it would depress exports and boost imports to rebalance the economy. However, the extent of currency adjustment required to meaningfully rebalance the economy would entail significant losses within the manufacturing sector. More importantly, this option remains close to the Chinese policymakers in the immediate term, as the yuan forces the opposite problem of depreciation pressure due to a loss of investor confidence in the economy as a result of zero-COVID policies. China could also seek to reverse the financial suppression it has engaged in, which it has used to channel cheap funds for investment, which the government prioritizes. For example, setting interest rates at very low limits, returns at very low levels, limits the returns for banks and households. State control of financial institutions limits competition in the industry, and credit is allocated inefficiently. However, the need to boost demand domestically could encourage leadership to liberalize the financial industry and bring in more foreign competition to increase deposit rates. Now, what's the base case scenario? I believe things will remain status quo in the short term due to the tough political concessions the government would have to make. Going back on zero COVID, drastically reducing support for SOEs, and relinquishing control of the financial industry may be too much to bear. Nevertheless, some financial deregulation and yuan appreciation may be possible in the medium term in order to initiate its economic rebalancing. Either way, Chinese leaders are aware of its exposure to the dollar and is starting to take action, including recently banning elites from holding overseas assets. Well, thank you for your time and hope you enjoyed my presentation.